Cold open, 10 seconds. Imagine a chess game where every move is silent. No shouts, no blunders, just a single pawn inching closer to promotion. That's today's market. Quiet, deliberate, and hiding a storm beneath the surface. INTRO, 10 seconds. I'm Raymond Bowie. This is your Qanexra Daily Brief. Yesterday's story, 60 seconds. Markets opened expecting a holiday lull, a pause after a volatile week. But here's the twist. The silence wasn't benign. Tech stocks, the engines of this rally, began to stall. Nasdaq futures dipped below the 15,000 mark, triggering a cascade of panic among algorithmic traders. Why? Because the smart money had been quietly shifting gears. You see, the S&P 500 had spent weeks flirting with a critical level, the 5,200 barrier. Traders thought it was a psychological wall. But what they missed was a deeper story. Institutional investors were rotating out of growth stocks and into value plays. The result? A 1.2% pullback in tech, while industrials and consumer staples surged. By the close, the Dow Jones Industrial Average closed above its 50-day moving average, whispering a warning. We're not done yet. This wasn't a correction, it was a pivot, and the market's next move hinges on whether that pivot holds. Raymond's take, 45 seconds. What most traders missed is the shift in capital flows. The smart money isn't chasing headlines, they're exploiting gaps. Look at Raymond's swing levels. The 5,200 threshold for the S&P isn't just a number, it's a battleground. If you're holding tech stocks, ask yourself, are you betting on a rebound, or are you bracing for a rotation? The answer lies in the balance between momentum and value. The market isn't rewarding risk takers anymore. It's rewarding those who adapt. And let's be clear, this isn't a bearish signal. It's a setup for either a sharp reversal or a slow grind higher. The question is, which way will the tide turn? Today's outlook, 30 seconds. What I'm watching this session is the 5,200 level. If the S&P closes above it, we'll see a flood of bullish options volume and a fresh wave of retail inflows. But if it cracks, expect a swift retreat toward 5,150, where the bears will gather like wolves at a carcass. Plan your trades, trade your plan. This is Raymond Bowie, Qanexra Capital. Close, 10 seconds. Stay sharp. The market's about to decide, will it dance or dive? Until then, I'm Raymond Bowie, your guide through the chaos. Deep Dive Masterclass, Audist Sell Trade Setup. Spoken script, 3 minutes. Hashtag the narrative, midnight to 0:45. Why is this asset moving? Let's dissect the macro context. The Australian dollar to US dollar pair is currently trading at 0.6696, up 0.01% daily, while the broader trend remains neutral. Due to mixed signals from moving averages, the underlying dynamics are shaped by global risk sentiment and interest rate differentials. Australia's central bank has maintained a dovish stance relative to the US, keeping yields lower than their American counterparts. This creates a structural bias toward the Australian dollar. Yet today's price action reflects hesitation. The RSI sits at 39.5, a neutral reading, suggesting no immediate overbought or oversold conditions. However, the AI-driven analysis highlights a strong trend via EMA alignment, indicating a potential shift in momentum. The key question is this a fleeting rally or the start of a deeper correction? The answer lies in the technical structure. Hashtag the technical structure, 0:45 to 1:30. Where are the critical levels, and why did we choose this entry? The Raymond swing pivot at 0.6702 acts as a crucial reference point. Currently, the price is slightly below this level, hovering near the S1, 0.382 Fibonacci, support at 0.6691. Our entry at 0.66951 is strategically placed just above this key support level, balancing proximity to liquidity zones while avoiding premature activation of stop losses. The R1 resistance at 0.6714 and S1 support at 0.669 form a tight consolidation range, with the ADR average daily range of 0.0025 confirming moderate volatility. The EMA alignment confirms a downward bias, suggesting the price may test the S1 level before reversing. By entering near this support, we capitalize on the likelihood of a short-term pullback, leveraging both technical and psychological factors. Hashtag the psychology, 1:30 to 2:15. Where are retail traders trapped, and why will they lose money here? Retail participants often anchor their positions to visible levels like pivots and Fibonacci retracements. The pivot at 0.6702 is a magnet for longs, with many traders placing targets above it, assuming a continuation of the recent uptick. Conversely, the S1 level at 0.6691 is a common trap for buyers who believe the price will bounce after touching support. These psychological anchors create a crowded order book where even minor movements can trigger mass exits. For instance, if the price approaches 0.6702, longs may panic sell, creating a cascading downtrend. Similarly, those holding shorts near 0.6691 might panic buy as the price nears their stop loss, exacerbating losses. The key insight? The market is saturated with trades anchored to these levels, making them vulnerable to rapid reversals driven by crowd behavior. Hashtag the trade plan, 2:15 to 3 o'clock. Execution details. Entry, stop loss, and target. We enter a sell position at 0.666951, targeting 0.662849. The stop loss is placed at 0.67285755 beyond the pivot, 0.6702, to protect against a false breakout. The target at 0.6628 is not arbitrary. It aligns with a major liquidity zone, likely influenced by historical support levels and institutional activity. The distance between entry and target, over 68 pips, allows for sufficient room to accommodate volatility while maximizing reward-to-risk ratio. Invalidation occurs if the price closes above 0.67285755, signaling strength in the bullish narrative. Conversely, a close below 0.6628 validates our thesis, reflecting a deeper correction. This trade hinges on the balance between technical clarity and psychological resistance, ensuring we exploit both the chart and the crowd's biases. End of analysis. Word count, 950. Duration, 3 minutes. Check the full track record at Qanexra.com/signals.